Today, folks, we're talking about this beautiful, juicy correction going on within these stocks because earnings are here. We're taking a look. It seems like earnings are going to be the defining factor where we go, and some of these earnings look great, yet stocks are still selling off, which means we could be in overbought territory. We're seeing the likes of Johnson & Johnson, some of these mega cap companies trading down this week. Tech is barely holding on for dear life as we head toward tech earnings. The S&P 500 giving up 3.5 percentage points of the gains this year, taking away that wicked 10% return that we had down to 6.82%. And I love it. I live for it, baby, because when everyone's shitting their pants, freaking out, I'd be buying. I mean, that's the goal, right? And everyone seems to be fear-mongering right now. And I love fear-mongering. It seems to be, a common denominator between influencers out there because they want to make those big bucks. And as I told you, I make these clickbait titles for you guys, get mad at me for it. But I'm doing it because I got to make that bank to buy these damn stocks. You got to do what the people want to see. And for some reason, people love clicking through on drama. But, I mean, they're all buying gold. Gold's still rallying. So the fear-mongering is working for those people out there. But taking a look at this week, what do we got going on? Well, we got Bank of America today. We'll talk about. We had JPMorgan. I think, what was that, last week? We're going to talk about some of those earnings. Johnson & Johnson posted today. We got to talk about that for those juicy passive income collectors. We got ASML. The big chip giants are going to be posting an ASML. TSMC, a lot of these companies I think are getting into way overvalued territory that need to correct. There's a lot of risk in these guys, but I'm very much looking forward to see where the chip sector sits, especially with this insane rally in buying from the mega tech companies, to see where that kind of persists moving forward. It'll be fascinating to say the least. We got Netflix posting on Thursday night, Friday American Express, Procter & Gamble, the ones that I'll be paying attention to. But let's start by talking about the banks like Pokemon cards. Damn it, you should be collecting all of these guys. Well, in the US, you want to collect the major banks, not the regional banks, depending on how you feel about it. Canada, the monopolistic banks, there's only a handful of them. They all operate the same. They all perform relatively in line. But with JPMorgan here, I think there's some fascinations going on because the stock's trading down pretty dramatically. I mean, it dropped 8.2%, which is huge after this just iconic rally since the 2022 low. I mean, you could have bought this at any point in time in the last year and a bit, and it's been running like a tech company, which is just gorgeous. But I don't think it's at value anymore because I always kind of like with these big companies, if you're a dividend lover and these are like real conglomerates, and JPMorgan is at a $516 billion market cap, you want to be buying them when they're favored based on their dividend yield. It's like one of the things that I pay most attention to. And right now, the dividend yield is sitting at lows that it hasn't seen basically since 2017 or going back to 2011. This is not that appealing. The best time to buy it was 2020, when it hit about almost a literal 4% yield or over 3.5%. We have to see some pretty big corrections to get back to that point. You kind of missed those blimps, those opportunities that really only come once in a decade or twice in a decade in this case. So I wouldn't really be chasing it here as much. Considering we take a look at the dividend GIGAR, it's been growing at about 7.5%. Payout ratio is beautiful at 25%. I mean, this is truly this kind of stocks that you want for your retirement. If we just take a look at the dividend history, we're talking about a company that is slowing in its GIGAR over 5 years, considering a decade ago you were getting 38 cents a share. Today you're getting $1.15, which was like a triple up. I don't think we're going to see that same kind of dividend growth. If we just take a look at a few other metrics here that I find really awesome for you guys as well, these are the kind of companies that I think have that perfect formula, right? They have an increasing dividend, they have a really low payout ratio, they have great earnings per share growth, and then you take a look at the shares they've been buying back over time. All of this is a formula to get that explosive growth you see in the stock. Now, we've even seen the likes of JPMorgan, the CEO, Diamond, Jamie Dimon we trust, the guy that's, always up there in arms with the pandemic and everything, guiding us through these economic hardships, seeing what the true, middle class is dealing with because they literally see everyone's bank accounts. But he's been selling a lot. I mean, this dude took $33 million off the table. I mean, a lot. I mean, this guy is just making bank on getting rid of shares. He's saying that he's doing it for diversification purposes. A lot of people are fear-mongering this, saying it has a lot to do with his fear of the bank. And there could be a mix of both. Who really knows? But honestly, it reminds me of Mark Zuckerberg selling the top of the market before the 2022 crash. And he used a lot of that money to build his bunker out in, where was that? In Hawaii. And that kind of reminds me of like Fallout. The dude's just prepping himself for the big nuclear fallout. But still, good show. You should check it out. But still taking a look at JPMorgan's earnings. This is great. Revenue growth is up, 9%. Really great to see here from, Q1 of 2023, 38 billion to 41 billion. We're seeing loan loss provisions slowly, start to diminish as loan quality starts to resume a normality. As we've talked about, this is a huge contributing factor to a lot of the write-downs in the company. And, again, when we move forward from here, because of the higher interest rates, they're going to benefit substantially. And that's what's kind of going on with Bank of America. They topped estimates on better than expected interest income. However, their earnings were just not that appealing. I mean, the stock did drop, but then again, every stock seems to be dropping on earnings. We can see it's taking a little bit of a blimp to the downside, this Warren Buffett favorite here, with a dividend yield that has slowly been growing progressively over time because the stock just hasn't really done anything, yet the earnings have been going up, the dividend increases have been going up. But just take a look at the revenue front of it here too. Shares outstanding, what I want to pay attention to, also buying back shares. Could be another perfect formula stock considering their dividend was at about 3 to 5 cents, a decade ago. Today at 24 cents. Definitely some good dividend growth. But if we take a look at the dividend scorecard, a little bit better, actually a lot better than over the last 5 years than JPMorgan. So, these banks, these mega banks are usually pretty good buys for those in retirement. If we take a look at revenue, relatively flat, slightly to the downside, from this time last year, 10 billion, 10.7 billion to 10.1 this year. Is it that exciting? Not really. It's not like JP Morgan. Net income's down from 3.1 to 2.6. Their loan loss provisions have been kind of trickling to the flat side here year over year, haven't really changed. So not the most exciting, but that's the banks. It'll be neat to see what the Canadian banks post, but if they follow in line with JP Morgan, that's what we really want to see. And we'll see if we can get some continued growth, because I don't think the Canadian banks have really rallied as much as some of the U.S. banks have. But if we compare it, let's talk about biotech, medical, Johnson & Johnson, a fan favorite for those collecting that wonderful passive income. We can see that it's yielding 3.28%, which is the highest we've seen quite some time, considering the stock is now trading down about 20% from its all-time high. This one, I'm really surprised more dividend investors aren't talking about it as much. Take a look at that dividend yield. It isn't growing like the banks are. It's probably the lowest 5-year Geiger there. But if we take a look at the dividend history, again, we're not seeing the same decade we've seen before. I mean, this thing was paying out 66 cents a decade ago. Today, $1.19. Almost the doubling of the dividend, not quite. Taking a look, they've been buying back a lot of shares during this down period, which I find fascinating. Just in the last few quarters here, definitely accumulating a lot of share repurchases. If we just take a look, though, at the other metrics here when it comes to that dividend, what is also fascinating is this is the highest yield you could have got basically from 2013. I mean, this is the highest yield J&J's ever paid in a decade. Something beautiful to just pay attention to. Keep it on your radar if you're looking for that income. If we take a look at earnings, we dive in here real briefly here. What I like to look at first and foremost is the diversity of this company. There's nothing more diverse, I think, than J&J. I mean, from a medical standpoint, take a look at the innovative medicine highlights. This is one segment of the company. Oncology, immunology, infectious disease. None of these make up a huge percentage of their income. Look at med tech, a whole different department. You got cardiovascular, vision, surgery. It's such a variety of different income metrics here. But if we actually just take a look at the earnings, they've grown pretty nicely. Again, nothing huge, but from 20.9 billion to 21.4 billion, really nice to see. Operationally, it's growing at a nice clip. We're talking, mid-single digits, nothing crazy, right? But that's what we want from a company that we're relying on income from. So if you need income today, I wouldn't really rely on it as growth, but it does have that perfect formula set. Revenue's growing up. EPS is looking great. They're buying back shares aggressively. The stock's down 20%. The yield's at a decade high. This is the opportunity, I think, to start accumulating these kind of stocks. Not as investment advice, but you can kind of see how favorable that was for a company like JP Morgan. Now, we take a look at the broader markets. They've been fighting aggressively every day. Every day they drop, they rally back. It's been getting very volatile as the VIX has been picking up steam as we head into an earnings season where I think these earnings will be a defining factor. We need a lot of beats. If tech can beat a lot of the market expectations, we could continue to see some more rallying, and this might just be a dip buying opportunity. But honestly, if we are in overbought territory, which it more or less feels like, we're probably going to see a continued sell-off, which is what I want because I'm buying companies. I really want to see Tesla below 150. They just laid off 10,000 employees. Everyone's up in arms about it, even though every company's been laying employees off right now to offer some operational efficiency. As I mentioned, I think Tesla's going to continue to drop into its earnings. I think this is going to be the worst year Tesla's going to experience in pretty much the last 5 years, probably going back to 2019. And then from there, I think, again, the story will pick up back in 2025 and 2026. This is my year of accumulation for a company like this, and I love seeing big tech companies finally just start to get so much negative headlines around them. Because I believe they're the future, and history has always been on my side when it comes to that. But I'll pass that question off to you. I'd love to know what you think in that comment section below.